Hello and welcome to Invest to the Moon, where I share with you the best tips and insights on investing. Today, I'm going to talk about one of the most successful and influential investors of all time, Peter Lynch. He is the legendary fund manager who grew the assets of the Fidelity Magellan Fund from $18 million to $14 billion in 13 years, beating the S&P 500 index in 11 out of those 13 years. How did he do it? What is his primary investment theory? And how can you apply it to your own portfolio? Let's find out. Peter Lynch's investment strategy is based on the simple principle that investors should invest in what they know. This means that investors should concentrate their investments in companies or industries that they understand, and they should avoid investing in companies or industries that they don't understand. Sounds simple, right? But why is this so important? Lynch believed that individual investors have a distinct advantage over Wall Street and large money managers because they can spot great opportunities in their everyday lives before professionals do. For example, if you notice that a certain store is always crowded, that a certain product is flying off the shelves, or that a certain service is gaining popularity among your friends and family, you might have discovered a potential winner before the analysts and the media catch on. By investing in what you know, you can also avoid getting caught up in hype and fads that you don't understand and that might turn out to be disasters. Of course, investing in what you know doesn't mean that you should blindly buy stocks based on your personal preferences or opinions. You still need to do your homework and research the companies that you are interested in. Lynch had a rigorous process of evaluating stocks based on their business models, competitive landscapes, growth potential, valuation, and more before investing. He also classified stocks into 6 categories: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays, and he had different criteria and expectations for each category. One of the key metrics that Lynch used to measure the attractiveness of a stock was the price-to-earnings ratio. This is the ratio of the stock price to the earnings per share of the company. Lynch preferred to buy stocks with low P/E ratios, meaning that they were undervalued by the market, and he avoided stocks with high P/E ratios, meaning that they were overvalued by the market. He also liked to compare the P/E ratio of a stock to its historical average and to its industry average, to get a sense of how cheap or expensive it was relative to its peers and its past performance. Another important concept that Lynch introduced was the PEG ratio, or the price-to-earnings-to-growth ratio. This is the ratio of the P/E ratio to the earnings growth rate of the company. Lynch used this ratio to measure how much the market was paying for the growth potential of a stock. He liked to buy stocks with low PEG ratios, meaning that they were cheap relative to their growth prospects, and he avoided stocks with high PEG ratios, meaning that they were expensive relative to their growth prospects. He considered a PEG ratio of 1 or less to be ideal. Lynch also had a knack for finding hidden gems among small-cap stocks, or stocks with low market capitalization. He believed that small-cap stocks had more room to grow than large-cap stocks, and that they were often overlooked by analysts and investors. He also argued that small-cap stocks were more likely to be undervalued by the market, because they had less coverage and attention. He said, "Big companies have small moves. Small companies have big moves." Lynch was not only a great stock picker but also a great storyteller. He had a way of explaining complex financial concepts in simple and relatable terms, using anecdotes and analogies from his own experience. He also had a sense of humor and a humble attitude that made him appealing to his readers and followers. He wrote several best-selling books, such as One Up on Wall Street and Beating the Street, where he shared his investment philosophy and his stock picks with the public. I hope you enjoyed this video and learned something new from Peter Lynch and his investment strategy. If you did, please give this video a thumbs up, subscribe to my channel, and hit the bell icon to get notified of my next videos. Also, leave a comment below and let me know what you think of Peter Lynch and his investment strategy, or if you have any questions or suggestions for future topics. Thank you for watching, and happy investing!